Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. The Nasdaq 100, the technology ETF, is going on a massive melt up right now, taking us into a territory that we've only seen once right before the top of the dot-com bubble that ultimately led to a massive bear market in both technology stocks and the S&P 500 as well. And the very same thing that popped the dot-com bubble back in 1999 is actually happening as we speak. I hope you guys are going to enjoy this video. Don't forget to smash the like button. It is massively appreciated. Without further ado, let's get right into it. Now, the Nasdaq 100 recently has been melting up. It has been the primary driving factor behind the S&P 500. It's really been all about tech stocks and the optimism around AI and stocks like Nvidia that have been going parabolic. And of course, it's a big bet to say that this is going to reverse now. When you see these types of big moves in the market, it's very difficult to actually say when they can come to an end. Now, of course, I can show you that the Nasdaq 100 is completely diverging from what the bond market is actually pricing in right now. This is a massive valuation pump when interest rates and bond market is actually telling us that we should be going in the opposite direction. But again, the market can remain irrational for longer than you can remain solvent. Going 100% short on these stocks right now is a difficult bet to make. But let me quickly take you back to August of 2000. I'm going to show you in just a second why we currently are at a comparable moment to August of 2000. Let me use this replay feature right here. You can see the Nasdaq 100 here was going on a melt up here in August of 2000. This chart feels like it's about to head a lot higher. You can see here if I put the Fibonacci retracement level right here to give us an idea of where we are in terms of retracement levels. You can see here we are at the 61.8% retracement on this rally, and the market is even exceeding that on this run. You can see following that, the market rejected and declined severely and began a bear market that lasted for 3 consecutive years. Now today we look at Fibonacci retracements here, and the stock market seems like it is unstoppable here and coming into the 61.8% retracement level. Now again, this doesn't mean that we're going to reverse here like we did in 2000, but I'm going to show you in just a minute why it's not actually completely crazy to think that we are in a similar situation, because the same thing that popped the bubble back here is actually happening right now while we're testing the same Fibonacci retracement level in a similar type of euphoric move, and as I'm going to show you right now, at similar valuations. Now remember, valuations, and this is the relative forward PE ratios of technology stocks against the S&P 500. So how expensive tech is relative to the rest of the market. And you can see more recently, we've had this ratio of valuations climb quite high. In fact, you can see if I draw this line out here, the only moment where we've actually seen tech more expensive than right now is right here between 1999 and maybe 2003 here. Now remember, valuations don't tell you anything about where the market is going to go. Valuations can continue going up and up and up, and it doesn't actually tell you that these stocks are going to reverse in the near term. But if you are at extremely high valuations, it means these stocks are very expensive. They're pricing in a lot of good news already, and so the runway for upside is a lot more limited than the runway for downside. That's all it means. That's all valuations really mean when you boil it down to the essentials. It's talking about the runway for upside versus the potential runway for downside. In 2013, tech was extremely cheap relative to the market, and look how these tech stocks performed against the S&P 500 following 2013. Of course, they outperformed massively and even more recently. But theoretically, these valuations could continue on moving higher. In fact, if you look at a similar level here in 1999 and what stocks were doing towards the beginning of 1999 here, tech stocks had just gone on a massive melt up, and they were about to go on a second massive melt up, taking valuations from around current levels here at the beginning of 1999 to even more extended valuations. This is why this type of euphoric type of price action is extremely difficult to time, because who knows for how long this can go? Who knows how long the market can remain irrational? Who knows how far these valuations can go? And if we take the tech bubble as an example, well, we know that they can go higher than where they currently are. We know that the market can theoretically get more irrational from here, and possibly even more irrational than where we were in the dot-com bubble. And by the way, something I find fascinating is that tech was actually even more overvalued here in 2001 during this bear market rally right here, 2001, than they were right here. So stocks were still in bubble territory right here in 2001 during this bear market rally. So now the question is, what caused this bubble to pop? And to us, it really comes down to the recession. This orange line here is initial jobless claims, and you can see here initial jobless claimed bottomed in March of 2000 at the same time as the market topped, the Nasdaq 100 topped, and initial claims began to rise as the economy, the underlying economy, was heading into a recession. And that's what popped the bubble and eventually triggered a massive bear market in technology stocks and caused these valuations, these very frothy valuations, to unwind. Now the yield curve back here was also inverted. Now this is a recessionary signal that was telling you were heading into a recession, and then the bubble started to pop. This bear market rally in August of 2000 actually occurred here at the bottom of the yield curve inversion here. Now let's take a look at what's happening today. You can first of all look at initial claims that have started to move higher recently as we are heading into a recession, as we are seeing a deterioration in the fundamentals of the economy. And you look at what could be a bear market rally occurring at the bottom of a yield curve inversion. Now, why is the yield curve important for the popping of the dot-com bubble? Well, look at this chart. This is the chart of the yield curve in red against coincident economic indicators. Now, if you think about the conditions that are necessary to actually have a bubble, it just needs to be a stable growth environment. It doesn't necessarily have to be a high growth environment, but just a stable growth environment that's enough for investors to get excited about a particular thing in the economy and take a lot of risk betting on that particular thing. If you're in a recession, you're not going to get a bubble. As the market begins to sniff out that economic conditions are deteriorating, the bubble, or the frothy valuations, however you want to call it, is going to unwind. And so you look at how the yield curve works, it's almost a perfect predictor of what the economy is going to do. And this chart proves it. You can see here economic indicators here are shifted backwards by 12 months. This black line is shifted backwards by 12 months. And you can see the yield curve predicts very accurately how the economy is going to go up and down on any given year. Now, currently, are we seeing things that are completely outside of our expectations? Absolutely not. The yield curve a year ago was not yet inverted. The yield curve a year ago was at around current levels, signaling that we should be in more or less stable growth territory right now. But in the next few months, look at what happened. Coincident economic indicators should start to move down very aggressively here as the yield curve predicts. And you can see that's exactly what happened here in 2001. And I'm talking about this recession right here. The yield curve inverted a year before the recession actually played out. Now, again, these stocks are on an incredible run right now. They have so much momentum that it is really incredible to watch. But from a valuation perspective, these stocks have a lot of risk associated with them. From an economic standpoint, they also have a lot of risk associated with them. So while it seems like maybe this is just the beginning of a massive melt-up type of bubble, if we study the dot-com bubble, we actually see that as soon as the market begins to sniff out a recession, the bubble begins to unwind. So before you start to take unreasonable risk betting on a massive AI type of bubble, as many people are doing right now, thinking that this is going to go on for maybe another year or so, as we have a similar type of development to the tech bubble right here that occurred leading up to 2000. Be careful, because if we really are heading into a recession, this type of bubble might not last as long as you think, and the fact that these valuations are so elevated might cause quite a severe correction. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button and click on the subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.